Welcome to Searching Smarter with Selby Jennings, the podcast for hiring managers and professionals navigating the job market within financial sciences and services. Whether you're searching for top talent to grow your team or considering your own career move, this podcast will help you do so with confidence. I'm your host, Jesse Scaff, Global Client Director for Faden International's Financial Sciences and Services brand, Selby Jennings.
The hiring decision is probably the most important decision that you're going to make, because if you get it wrong and you have to retool again, not only are you hurting those people that are moving in and out of the organization, but you're hurting the team that you're hiring for, because they're going to be operating at that debt. Has the bar been raised in the investment business? Probably, but it's been raised in any other professional discipline as well. We've got to be faster. We've got to make decisions faster. The time lag is just that much shorter. Everything is not knowable. Markets are not efficient. We don't know what's going to happen before it's going to happen. And so the most important thing for any investor to be able to do quickly is
Today, my guest is Marc Greenberg, lifelong long-short equity expert. Marc has done everything from analyst to portfolio manager on both the sell side and buy side, and from research to talent development, where he has recently launched his own consulting business in support of medium-sized hedge funds. Our discussion today includes the current era of talent on the buy side, how hedge funds attract and develop that talent, emerging and perpetual skill sets required to succeed at funds, and the Quantamental approach to investing. So tune in and have a listen. Hi, Marc. Good to see you. Thanks for being on.
My pleasure, Jesse.
I want to start with how we got connected, which was actually through a Business Insider article. I'm not sure if you're aware, but Dan DiFrancesco, who was the chief editor for the Business Insider morning newsletter, was a previous guest on this show. Mm-hmm. So that's how I came across your feature in Business Insider.
Great. Well, I'm happy to be here. Look forward to talking with you.
Absolutely. So let's get right to it, and kind of like on that same thought, tell me about your career. Give a little bit of an introduction. I know you've recently undertaken an entrepreneurial endeavor, but you have lots of buy-side experience. And today we want to talk about the buy-side and the talent around the hedge fund industry as a whole. So tell me a little bit about how you got started and how you've come to your new company, which is Greener Pastures.
Well, me in brief is I started out on the street a long time ago as an analyst and portfolio manager on the buy side, doing long-only work. And then after about 14 years of fund management, I joined the sell side as an analyst, first at Paine Webber and then Deutsche Bank, where I was a sell-side analyst for 10 years. And the last couple years, I started working more with younger analyst, became co-head of associates at Deutsche Bank, and parlayed that into associate director of research role at then SAC Capital in 2011. We worked at SAC Point 72 for 7 years, from 2011 to 2017. In research, became the director of research, head of professional development, and started an incubator there called Idea Lab, which was one of the first kind of quantamental things that integrated data into process, and tried to think about ways that everybody could use their nerd skills more to be better investors. From there, I went to a firm called Synctive Capital, which was a true startup, where we launched in 2019 and grew to over $1 billion. Great experience to learn how to build a business from Rich Schimmel and Larry Sapansky. And then most recently, before starting Greener Pastures, I was the director of research for a period of time at J. Goldman and Company. My decision to start my own thing was predicated on the idea that there are a lot of small to mid-sized funds, call it 500 to 3 billion in range, that for a lot of reasons, mostly because of manpower, won't address some of the core issues around research management, talent, and professional development in a full-time way. And most of the time, what you see with newer funds is that you have a successful portfolio manager or person that is able to build a team, is able to put up a great track record. Most often they come from other funds and they spin out. But the people management side, the how do I get my juniors on a development curve to improve? How do I think about hiring the right way? How do I think about all the resources and data that I need to compete in long-short equity? I felt as though there was an unserved need in that market, and I'm happy to say that there are a few clients that think so. And so it's been a good start to that. Along with that, I also write a Substack called The Long and the Short of It, which is about mostly nuts and bolts, long-short equity type things, like how to build a language and, how to attend a conference and how to write for clarity and, how to overcome sort of cognitive biases, which kind of haunt all of us as relate to many of the decisions that we make. And, between the writing and the starting the business, keeping myself pretty busy.
Sure sounds like it. I think it's a really interesting career path just because we don't see a ton of research professionals lend themselves into the talent side of things, right? So I think it's really interesting how you've parlayed research and tied that into the talent identification, talent management, talent development, which obviously is highly relevant for what we do. So what was it in the research side of things that interested you in the talent side of things that made you want to start this?
I'll give a good example. For anybody out there that's a techie, they'll know that when you kind of put duct tape and glue together and you just kind of apply systems to existing systems and build things without any kind of a comprehensive approach, you build what's known as tech debt, which means that sooner or later, the thing that you've done to kind of put a finger in the dike is going to need to be walled down and a new dike is going to have to be built.
Sure.
I think it's a very similar kind of challenge in talent. I think people want somebody to do a thing, or they want somebody to solve a problem, and they don't think kind of comprehensively about how it's going to affect the team, what it's going to mean for how they trade, how this person is going to build and grow into something beyond what that initial use case is. And especially really when I was in the co-head of associates role at Deutsche Bank and then into Point72, where there was a lot of hiring because you're talking about very large organizations, you begin to see how people make those decisions. One of the things that I wrote about today are the archetypes that we commonly refer to when people are hiring. They want someone who's really shiny. They want a great resume. They want accomplishments, high GPA, achievements, track records of success. And a lot of the time, those people don't measure up in long short equity for one reason: they haven't failed. And failure is part of what we do. And so maybe the makeup isn't there. On the other side, you have sort of the gritty, scrappy type that has become very popular. And, those people are often maligned as having, lesser schools or lesser grades or lesser accomplishments, but they have pluck and the ability to just kind of grind and do things. And I think it's a complete and absolute total waste of time to put people in those buckets. Nobody wants to be in a bucket. It's easy to sort, but it doesn't tell you anything about whether or not those people are able to do the job. And after hiring hundreds of people over my career, you've got to be more robust in your thinking about putting people in roles, not just what does the portfolio manager or the team want, but what's best for the firm. What kind of tools can we put in place to help these people succeed? How are they going to grow? As a director of research in particular, the hiring decision is probably the most important decision that you're going to make, because if you get it wrong and you have to retool again, not only are you hurting those people that are moving in and out of the organization, but you're hurting the team that you're hiring for, because they're going to be operating at that debt. So, important to get the decision right, limit turnover. And so I've spent a lot of time thinking about it.
Well, certainly relevant for what we do here. And I completely agree. It's very different. Obviously in a grad sales model, we'd be comparing apples to something far beyond oranges to, consider a grad sales to portfolio management and long, short, fundamental equities talent. But essentially, it distills down to the same thing that we're looking when we're hiring here. We're looking for strong people skills, and I guess what in a cliche manner would be considered soft skills, not just what's written on a resume. And further, the way we present that to our clients with the candidates that we are presenting, we're trying not to just summarize a resume, especially in hard to fill niche skilled positions. It's so much more important that we as the agent are representing exactly what you just talked about, what the candidates have done as far as adversity and challenges, facing and overcoming challenges, not just, summarizing the top 2 or 3 bullet points on their resume and the 4 places that they worked before this current position, right? So there's so much more to a candidate's background. There's so much more to a candidate's experience than what might be written on a single page. So relevant for us. So that brings me to my first question, kind of an observation that we've seen here over the last couple of years, specific to the hedge fund industry, that it seems that the bar for talent in the hedge fund industry has just continually raised year after year, especially on the technology side.
Yeah.
In the systematic and quantamental side. We're going to buzz that word a couple times today, I think. And of course, as the universe of talent around it goes up, so does the fundamental talent and the talent on the fundamental side too. What are your thoughts on that? That the bar for talent in the hedge fund industry has increased. Do you have any thoughts as to why that might be as well?
The ability to integrate data into decision making is a must-have, and I think if you go the way of the traditional finance track and you learn how to model and you do banking or private equity, and you're not doing anything other than the pure financial train, you're going to miss a really good part of the movie, which is how to get to those decisions, how to adapt to changes in the world, how to quickly integrate all the information that's flying at us at faster and faster speeds, how to use the tools that are available to do that, whether it's coding, whether it's just the ability to be very efficient and organized about the things that you bring into your data and decision process, whether it's just the ability to do scenario forecast and to think probabilistically about what likely outcomes are going to be. Those skills existed in the best players for a long time, and now it's very much kind of table stakes if you don't have that. I just don't think that you can be a very viable market participant. The world moves too fast. So has the bar been raised in the investment business? Probably, but it's been raised in any other professional discipline as well. We've got to be faster. We've got to make decisions faster. The time lag is just that much shorter. And in the precious, coin of the realm that we talk about, which is alpha, it also moves very fast. And so if you see it, if you get a glimpse of it, if you think it might be there, you've got to jump.
Do you think there are emerging skill sets that's separating the best talent these days, or perhaps that are separating the better funds from the medium performers or laggards? Either way,
I don't think that I would cut it on the fund line, because I think that this kind of talent archetype exists everywhere. The decision-making process that we ask people to do, and I think that these are not new skills, but the way they're discharged has changed a little bit. The most important thing for any investor to be able to do quickly is manage their time, allocate and prioritize the resource that is finite. There's going to be an infinite amount of information that one can find. Everything is not knowable. Markets are not efficient. Yep. We don't know what's going to happen before it's going to happen. And so most of the value add that we contribute to a process relates to the fact that we're thinking about how best to manage our time. And the tools and resources that we have now to do that are better.
Most definitely.
Simple scheduling tools, all of these AIs that are coming out, any good software program that I see or look at. I mean, by the way, I'm kind of like, I'm on that train, I'm like, if it can help me, great. And I don't spend 5 seconds thinking about what this technology is going to do to the world in some dystopian way. Like, it's here, build it.
Use it, utilize it. It's an augmentation. It's going to make things better.
Right. And so be mindful about the things that can improve and optimize how you spend your time, and prioritize the things that are the most important. And then stage 2 of that is obviously how well you communicate and how effectively you can convey the ideas and the information and the data that you collect. And again, that can be partly a systems issue. That can partly be whether or not you're going to use the tools, the newer communication tools that are available online, or, simple chats and Slacks and things like that, or wikis, you name it, or if it's going to be an internal system, or if it's going to be something that helps you catalog. But the ability to collect data, store it, communicate it, use it, that's the differentiator. And so that's going to help you communicate better. It's going to help you manage your time. It's going to help you make better decisions. And so I don't necessarily think that the ones that succeed are, just uber super nerds that are so data centric that they figure all this stuff out and they get to it. I think they're reasonable probabilistic thinkers that understand that these are tools that are there to help, and they come in lots of shapes and sizes and colors.
I was at a AI symposium back in November, and actually the CEO of that company was a recent guest on this podcast. And a lot of the talk was about individuals and teams and organizations' ability to harness data,
Right.
presenting more use cases and utilizing use cases rather than finding more data and simply just combing through it for the sake of, being a data scientist or data engineer. It's the application and use. And those, like you say, those who can harness it and utilize it and find arbitrage opportunities in it, that's where that delineation, of good to great might be happening right now.
Yeah. I mean, to put some math on it, what you want data to do is to stack in a way that's going to improve your probabilities of a good outcome. And so if you have four things that help you arrive at a decision, a typical analyst will look at financials, will talk to management, will read commentary for the street and look at some alternative data. That's four things. Do they have the cumulative effect of raising the probability that the decision you make about a stock is going to be correct? Well, is there one incremental thing that's going to take your probability from 55% likely to 60 or 65% likely? Those are the little incrementals, or what I call bank shots, the things that happen in addition to what you're already looking at that raise your likelihood of success in a business, especially long short equity, where a very, very good portfolio manager is right 55% of the time. Getting to 60 or 65 or 70% probability can change the outcome of an entire portfolio. And that's where finding the right data comes in. It's incremental. It raises your likelihood of success.
Yep. I guess as a big sports fan, I liken it to the advent and the augmentation of analytics in front offices, right? They're just trying to be 1% better than that division or conference rival, and find the small opportunity that maybe the other organizations haven't seen yet or identified or something like that.
I totally agree with that. But that having been said, I'd rather just have Mahomes. Right. I mean, you still want to begin with elite talent. You still want to find people that are great. I talked about sizing in portfolios and knowing when you have a big bet as a thing that is a critical skill that's kind of lost. And I talk about football a lot, and if you watch Derrick Henry play football, he's way bigger than everybody else, and he's faster and stronger. Just give the guy the ball. Like sometimes it's that.
Don't overthink it.
Right. And I think when you identify the right talent and you see somebody that's just better for however you're defining it, you want to try to capture those people. So yeah, I love the stats and I love the incrementals. And I think if you can make somebody a little bit better, that's awesome. But start with as best that you can.
I agree with everything you said just then. And I want to continue the conversation. However, I can't let it just be said. I have to put Tom Brady ahead of Patrick Mahomes. That's my guy. It's my guy for life. I agree in principle with everything that you just said. However, if we're talking goats, there's one, and I agree. Why not just start with Tom Brady, and then you can have Mahomes after that. But
right,
in theory, all accurate observations, and as far as they relate to financial markets, I'm with you entirely. Right, back to the buzzword. I know we talked about it a couple times. The Quantamental businesses, or the systematic businesses that are more popular, obviously quant trading becoming a lot more popular on the street, in addition to just fundamental. Some shops have quant businesses and systematic pods. Talk a little bit about what you're seeing in that side of the industry, and are there, aside from the obvious, talent discrepancies in the Quantamental or systematic sides of things as well?
I do think it's important to note that every time we get an iteration in either technology or the way people do business or the kind of talent that people are looking for, there's this growing concern amongst the traditionals, whoever was there first, that there's going to be some form of obsolescence, that, the traditional long short equity pod is going to be obviated in terms of what firms need from it now that all these quants exist and everything else like that. And I will tell you with very high conviction that I see no world where the humans go away. And I think that markets in particular will remain the domain of predominantly humans, because things happen in inefficient ways. Humans don't do things that are completely logical, and we don't have perfect information. So it's impossible to overstate the value or the importance of what is called sentiment or setup on a name. And I think one of the great fails among the current systematic businesses out there are that their returns sometimes are limited or mitigated by the fact that there's not enough work going into what the collective market participants actually think is going to happen. And that's where probabilistic forecasting becomes really critical in making an assessment of whether or not you want to be long and short a name, or if you want to stay or get bigger or get smaller or flip. Those trading decisions are going to be done, at least in my opinion, with some stronger inference from humans than they are going to be by machines. Now, there's going to be an awful lot of them that are mechanical that are going to be done better by machines, especially if I have a time horizon that's longer. I'm independent of short-term variability in stock prices, and I think I've done a lot of work to get me to this thing out here. I think the quant systematic strategies can be very good, but most of them are premised on this idea that there's something to arbitrage in the marketplace and that there's an anomaly to be exploited. That's what they spend all their time modeling and trying to figure out. One of the more popular forms of a quant strategy is called stat arb, or statistical arbitrage. And inevitably, the thing that they're trying to arbitrage goes away, and then they have to go find a new thing. Well, a traditional long-short model would begin by being very adaptive to begin with. What's going on now? How do I adjust to it? What's going to change? And so as long as both the human and the machine can evolve, then I think they can peacefully coexist, and it's not one versus the other. But adaptiveness as a skill, I think, is really, really critical. And in order to be adaptive, you can't have any biases. And so maybe one of the reasons the machines are doing a little better on that right now is because they don't have any biases except for what's written into their code.
That's a very human response for what is a traditionally data-driven, quantitative, numerical, statistical approach to the market. So it's an area that we spend a lot of time focusing on. It's an area that we as a business have success in. So that's a really interesting perspective. So thanks.
No, it's my pleasure. I mean, the best people, the best humans are analytical. I mean, the thing that you hear most often in our business are sort of blackjack or card player analogies, as though you know, based on the hand that you have, what your likelihood of winning is. It's like the numbers on the World Series of Poker when you watch it on TV.
Yeah.
You know, the best traders know that sort of intuitively, and that's sort of how they make money. And obviously the machines begin with that.
Right. All right. So I want to close just by giving you a little bit of an opportunity to tell us some more about Greener Pastures and the work that you're doing.
Sure.
Still adjacent or directly involved in the hedge fund industry.
Yeah.
And then finish with just a little segment after that we like to do here. So tell us about Greener Pastures.
You know, the business itself is designed to serve mid-sized funds where the resource to attack talent development and professional development is lacking, because most of the time it's a full-time hire of somebody like me in a director of research or head of development role in that very large funds that exists. It's not going to be existing at newer funds or smaller funds because they're resource constrained. The competitive advantage of scale is that large funds can hire people like me, come in and help make people better and think about the right way to hire and think about the right way to resource and use data. And the small to mid-sized funds don't have the luxury of that resource. And so serving it as a consultant and coming in and identifying problems, helping people get better faster, kind of getting them up the curve, identifying areas where they can be smarter about both the talent that they bring in and the resources that they utilize. And, you know, not just people like me, but people in data and analytics and people in risk are very important, you know, for smaller funds. And I think the gap to compete with the larger funds, it always felt like one to me that was arbitrary. You know, it could be served in a way that this kind of a business model could offer. And that's why I hung out a shingle and said, let's give it a shot.
Awesome. Great. Well, like I say, so relevant for what we're doing here as far as talent is concerned, and bringing the best talent and developing the talent in the industry. So I thought you were a perfect guest to have on, and I'm glad that Greener Pastures seemingly has quite a bit of open field ahead to run with that pun. So last thing is just a little segment called Underhyped or Overhyped.
Okay.
I want to get your take on that, and then I want to hear from you on just a podcast that you're listening to, or a book that you're reading, or a TV show that you're watching these days. So let's bring it back to the buzzword. Let's finish with the Quantamental stuff. Underhyped or overhyped? Quantamental will overtake the traditional fundamental long-short equity or fundamental investment strategy as AI and more data and more technology becomes prevalent.
Underhyped. Be afraid. Be very afraid. I think the future's here. I don't have a view that one can do things the old way and be successful. You have to adapt in this business. And if the data and tools are there to make you better, grab them. Grab as many as you can. Be smart about it, obviously, but, no going back.
Love it. And aside from searching smarter, obviously, which I know is, I'm sure the top of your commuting list for podcasts. What else are you listening to? What books are you reading? What shows are you watching?
I consume a lot of different things. I'm hopelessly out of date in terms of my musical interest relative to my kids. So I won't even go there.
I bet offline you and I have more similarities than I think.
I listened to a great podcast about what's going on in the Middle East called Call Me Back with Dan Sinor, which talks about conflict in Israel and how it's being resolved. I listened to a few things from the Times. I like Bill Simmons for sports, even though he hates the Knicks and he loves the Patriots.
I was going to say, big Boston guy there. That's why I like him.
Books on a lark with a guy that I work with. I just read The Fourth Wing because it was on the Times bestseller list, and I haven't read anything on the Times bestseller list in a while. It was just sort of this futuristic, thing that, everybody's reading. And so I was like, okay, what's the hype? And it felt very Game of Thronesy, so I got it. It was kind of fun. That's about it. I read lots and lots of different things. A lot of them are very boring. Some of them are history. Some of them political in nature. Always want to learn about markets. I think history is a very good teacher. And I read a lot of historical books.
Wonderful. Well, thank you so much for your time. Great to have you on.
Yeah.
I think a very, very insightful conversation. I think highly relevant to a lot of both of our audiences. So it's been a pleasure, and I will talk to you very soon.
Very good. Thanks, Jesse. Have a good day.
Thank you, Mark.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.